If you're invested with a robo-advisor or financial advisor at the bank and you did not select a maximum risk level of 10, you're investing all wrong. I'm going to show you how even selecting a maximum risk level of 10, for example, with a robo-advisor, is still considered a medium risk level. So you'll still get to maximize your returns on your investments in the stock market without your money going to zero. So if you selected anything less than a risk level of 10 out of 10, you will be missing out on returns. So keep watching this video. In fact, I'm going to give you something complementary to this video, and this is a portfolio projector that will show you what a difference sacrificing 2, 3, 4% per year in returns can make on your overall portfolio. It's huge. All you have to do is comment portfolio below, and I will hook you up the link to this sheet. For those of you who do not know me, my name is Michelle Hung. I'm an author of 2 investing books, The Sassy Investor and Investing for Teens, How to Save, Invest, and Grow Money. I'm a financial educator and also a fee-only financial planner, helping people build their 6- and 7-figure investment portfolios in the stock market. In this video, I'm going to be showing you why your money hasn't grown in the last 5 or more years. And if you continue down this path, you're still not going to see a lot of growth in your portfolio. And so I'm going to show you what you can do now to change that without worrying about your money going to zero, and how a maximum risk level of 10 out of 10 is still considered medium risk, but still provides you with maximum returns. Say you selected a risk level of 6 to 8. It means your portfolio is roughly made up of 60 to 80% stocks, and the rest are in low risk investments called fixed income or bonds. Bonds serve as a cushion for your investment portfolio because they provide stable, predictable, and recurring income. But these things are terrible for long-term returns because there's not much of a capital gain component. So for example, here is a bond ETF. The risk level here is low, very low. And why is that? Because the returns are predictable, recurring, and pretty much almost guaranteed. But the sacrifice is long-term returns. There's not much capital gains to be made when it comes to bonds. So if you look over here, the average 10-year return on an annual basis is just over 1%. Okay, horrible for long term, versus the Canadian stock markets. As an example, over a 10-year period, the average annual return is just under 8%. So imagine diluting your portfolio with these types of returns. If you selected a 7 or an 8, 20 to 30% of your portfolio is going to be involved in these types of bond ETFs. You're getting mediocre returns in the long run. You're investing your money anyway, so you might as well maximize your returns and remove fixed income from your portfolio. Of course, that depends on when you need this money. Like if you're very close to retirement or you're in retirement, you'll want less price fluctuations. And even so, there's no guarantee that fixed income will provide you with reduced price fluctuation, especially now simply because interest rates are on the rise. And when interest rates go up, bond values go down. So why do people want these in their portfolios? Again, they provide recurring, stable, predictable income. It's good for when you are replacing your employment income when you're retired. So let's say you up your risk level to a 10 out of 10. That means your portfolio is in 100% stocks. This is still considered medium risk level overall, and this is why. For example, a typical robo-advisor portfolio will put your money in several ETFs, categorized generally by geography. There will be a Canadian ETF comprised of Canadian stocks, a US ETF comprised of US stocks, a global developed ETF comprised of stocks from developed countries outside of North America, and an emerging market ETF, which are comprised of stocks from developing countries. You basically have a portfolio of stocks from all over the world. So here is one ETF where it has stocks from all over the world except for Canada. It is still classified as a low to medium risk investment because it is globally diverse and it has over 9,000 companies in here. Your money is not going to zero. Okay, so what's missing in here is a Canadian ETF. So if we go over to a Canadian ETF, the S&P TSX Cap Composite Index ETF, this ETF holds over 200 Canadian companies, and the risk level is still at a medium level. So between this medium risk ETF and this low to medium risk ETF, you have a diversified portfolio comprised of stocks from all over the world. And if we check out a US ETF, which consists of US companies, It's also considered a medium risk level investment. So the point is, don't be afraid to select a 10 out of 10 portfolio where you end up in 100% stocks, because at the end of the day, having a globally diverse stock portfolio is, according to the experts, still medium risk level. So you can most certainly sleep at night knowing that you're maximizing your investment returns, because it's not going to be diluted by bond or fixed income investments, by taking medium level risks. And having bonds doesn't mean you're immune to short-term volatility. It just means that if everything is going down, it just goes down a little less than stocks, but it's certainly not going to go up as much over the long run. The tragedy is, if you're going to be diluting your investment returns with these bonds that provide only mediocre returns over the long run, we're talking about you'll be sacrificing 2, 3, 4% per year of returns. And this adds up to so much money, as you can see here. If you dilute your returns by even 3%, you're going to take yourself from a $745,000 portfolio to a $416,000 investment portfolio. As you can see, sacrificing a few percent per year in returns adds up to so much money, which is why it's so important to make sure that the fees that you're paying are very low and you're maximizing your returns and your risk level for the right reasons. By the way, if you want the sheet, comment portfolio, and I will hook you up with the link for this.